Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is David Morgan from themorganreport.com. He's one of the top, if not the top, silver experts. Thank you so much for joining us today, David.
Well, Elijah, always have fun with you. Thanks for having me back.
All right. Now, the last time we had you on was on our SD Weekly Metals and Markets wrap about a month ago. You said that the Dow and the S&P were breaking through their support lines and that we were seeing a real trend change. Did you want to give us an update on that? Is that continuing?
Yeah, we're right at that point again, which means we peaked early in the year around the 2850 something level on the SPX. I'm just going to use the SPX. You can verify it with the Dow or whatever index you like to use. I think the S&P is probably the best. And then we dropped all the way down and we intersected the 200-day moving average. We blasted through the 50-day and all the way touched the 200-day, and it bounced off that, went up to about 2,800 on the index, and then it came back down and it pierced the 2,600 level, which again is the 200-day moving average. Right now, since then, the last couple of months, what you're specifically asking, we went up to about 2,700, broke through the 50-day moving average, bullish, and then it fell from there down to about the 2,600 level, which is just about kissing the 200-day moving average, which is 2,610. So right now, looking at it technically and also sentiment-wise, what we've had is a peak, a lower peak, and a lower peak, every time bouncing off the 200-day moving average, and that, my friend, is a definition of a downtrend. So we do have a downtrend. I think the top is in. I think we'll continue a downtrend, but there's a lot of pressures both directions. And as we all know, with a channel like yours and most channels that are truthful about the current state of the financial markets, there's so many algorithms and quants out there and basically computers trading against each other that they can perform this lighter than air type of situation for quite some time. But that doesn't negate what I just told you. The trend change looks to be intact. Nothing has changed from what I said earlier. It's being verified. What we really need to see, I guess, is that we break through the 200-day moving average and it doesn't bounce up and out of it quickly. And we see, let's say, a waterfall decline from that point. So if, as an example, let's say we pierce the 2,600 level and it shoots down to 2,550 and then down to 2,500. Now you've substantially broken it. It could pop back up, and it might. But once you get kind of a waterfall decline, then all these algorithms turn from bullish to bearish, and they'll start selling on command. Now, they can be rigged to go the other direction. So I think I've overspoken, but that's it. I'm pretty well convinced at this point that I'm correct as far as a major trend change. These things don't happen overnight. There's a ton of momentum in the stock market still, and there's a lot of rah-rah, sis, boom, bah that goes on with it on the mainstream financial markets, and that won't change.
Now, you're talking about a possible waterfall decline. On a percentage basis, what would that look like?
Well, to get a bear market, even a correction, like a 10% correction, which we've had. To get into like the bear mode, most analysts say you need about a 20%. So if you go from the 2850 level, 20% would be 20, so 360, you need 6. You're beginning to get down to around the 2350, 2300 level before, most technical people would call it a bear market. And we haven't seen that yet. We've had a correction. We've seen about 10%, but we haven't seen 20%. So that's where I would be, vindicated, like, okay, no one can say that it's not a bear market now. Really, right now, it isn't. So I hope I didn't misstate anything. I'm just saying my opinion, strong one, that I think the trend change has happened. As far as verifying we're actually in a bear market, technically we haven't seen that, not yet.
Now, as for gold and silver, I know the last time we had you on, correct me if I'm wrong, but you were saying that kind of a reverse thing is happening to gold and silver. We're seeing signs of a new move up.
Well, we've finally seen silver catch up to gold a little bit. I mean, silver had 3 days in a row where it broke through the 17 level on the spot market and stayed there over 3 days. And I actually went long on a leveraged basis, and then the next day it opened and it was well below 17, so I took the loss. I still have a trading position in one of my favorite stocks. It's got a high beta value relative to silver. But, what we're seeing is more consolidation still, and it's starting to really grind a lot of people, and I get that. But if you take it from a more longer-term perspective, from 2015, the end of 2015, gold keeps making higher lows, and silver has made higher lows and gone sideways. So with silver looking like it's starting to move, and that's questionable right now as we're doing the interview, we are seeing the gold-silver ratio come down from the 82 level down. I think it hit about 78. I don't know where it is today. I haven't looked, but we're ready. We're ready for a launch for a lot of reasons, but yet, isn't it going to happen? And the answer eventually, but for me, forecasting exactly when, I don't like to do that. As you know, do I play that game? Yes, when I'm asked to, but I'll just have to wait and see. I'd like to see it go above 17 again on a lot of volume, and then maybe test it on the way down and bounce right back up off of that. And then I would be convinced that, we've got some move to the upside. I'll just tell you right now, everything I'm looking at, I still look favorable to silver right now on the short-term basis. I look for a pretty good rally into maybe the second or third week of May, and that may be all we get. And of course, even that's conjecture. We'll have to wait and see.
Now, you've also reported on recently the idea of a silver deficit, and a lot of people are reporting that silver is in a deficit right now, but you talked about how this can be misleading. Now, did you want to give us an update on this? What does a silver deficit mean, and what does this mean for the silver market?
Well, there's really, a couple of, there's really two definitions of a deficit. If you look at the way that the Silver Institute reports a deficit, what they do is they take the, mining supply and they take all of the demand, and then they say, that mine supply didn't meet all demand, and you have a deficit. Or you could say that all mine supply plus recycling didn't meet all demand, and you have a deficit. That makes sense. The problem is that if you look at it objectively, like you're just looking through a pair of binoculars from the planet, from the moon, and you're looking at the inventory of above ground silver, you see that continues to build higher and higher and higher. So can you have a deficit and an increase in inventory at the same time? And the answer is yes, depending on how you define deficit. If you define deficit as all demand, including investment demand, even though that stockpile is growing higher, all of that silver that's being added to above ground every year is already held by, let's say, long-term investors. Whereas if you look at it objectively, that silver is available at some price. So I just want to make that clear to everybody. Certainly, I'm still a silver bug. And, when I pointed out that the silver supply above ground has continued to grow for the last 10 years, I got my fair share of hate mail. But it's public information. I mean, it's not anything that takes a rocket scientist to find out. All you need to do is go to the Silver Institute's website, and that information is publicly available to anyone. So you can look at it. So I like the guys at the Silver Institute. I know them fairly well. I certainly know the people at CPM Group that basically would tell you what I just said, that the inventory build is not a deficit. But you can have it both ways if you want it. The point I'm making, I forgot for a second, is, look, if you don't like the fact that the inventory of silver is building and has for the last decade, then you never touch gold, because gold has built an inventory higher and higher and higher every year since gold became precious. So it's not a function of the above ground inventory. It's really a function of how much demand is there in the investment market. And silver has the luxury of at least 50% of the demand coming from an industry that wants it regardless of what the price mechanisms are. So when it's low, they're very happy. When it's high, they still have to use it, so they still have to pay a higher price.
Now, as for above ground inventory, do you see when the gold and silver markets finally take off that there will be a real deficit or a reduction in the above ground inventory?
Well, I don't think we want to look at the above ground inventory, although we could. I think what we want to look at is whatever inventory is, it is. What we need to see is there more demand than that inventory can cover, and that comes to become public knowledge. So in other words, when we get such a demand on either of those metals or both at the same time or nearly the same time, then we have a real problem. So for an example, let's say that a major player in the electronic space demanded so much silver off of the exchange, and they stand for delivery, and the COMEX can't deliver on time, and they start to delay it. Well, leakage of that coming out would really stir the markets, at least initially to the gold community, the silver community, and then that would spread through the web pretty quickly. So that wouldn't mean that the inventory above ground has changed. What it means is that the people that own the inventory above ground aren't willing to sell at that price. There isn't any that can be bought at the new price. So the price has to change rapidly for somebody to cough up their silver and deliver it to this entity. So what we really need to see, and what I think could happen, and I've said it for years, and so far it's only occurred in the retail market, and that's where the demand is so great that the supply that's available, not that's above ground, but that's available to be sold, is so small that the two don't meet and the price rises rapidly, which is what we saw in 2008 in silver and gold, where the demand for retail product exceeded the supply that was available for sale at such a level that you basically couldn't find it. I mean, if you interview Andy Schechtman of Miles Franklin, I know his competitor, I know he was SD Bullion, so forgive me, but facts are facts. But he ran into a situation where he thought for a while he was out of business because he could not find retail product in quantities of any size to be able to put his markup on and sell to the public. In other words, if he couldn't source supply, he's out of business. And that actually happened to him for a short period of time. Things fell back into place. So can it happen? I would argue it has happened, but not in the complete silver market. And what does that mean, David? Well, that means if you went to the COMEX like I did, and you bought right off the exchange as I did, and you bought commercial bars, which are 1,000-ounce bars, those were available at the price set in the paper markets. So, I don't want to make this confusing. I don't think I am, but what I'm trying to explain is that once that situation that I explained in the retail market happens in the commercial markets, it's game over. Will it happen? I don't know. I believe that it will happen.
And what are some of the triggers that could make that happen?
Well, it will be what I've talked about for years, and that's, once there is a trigger point, a fundamental shift in thinking where the trust in the system breaks down to a level where the psychology of the markets in total collapses. So from one day of being confident that the U.S. dollar will always be there, that the bond markets will always retain their value, that at some point in the future you can always get to your bank account. When that faith and confidence is lost, then there will be a rush to gold, a run to gold you've probably never seen in the history of mankind. The reason that's true is because of the instant communication level that we have now, the instant availability you have to your brokerage account or your bank. I mean, never in history have you had the ability to, be on a smartphone, go into your bank account, and pick a stock out on your E-Trade, or for example, or Scottrade or Ameritrade. I'm not favoring any of these, and just push the button and either buy or sell. You do the same thing in the gold market. So once the confidence is lost by a certain amount of people, then you hit the tipping point. It's kind of the 100th monkey argument, and there's very few leaders and there's a lot of followers. So once people go through that door, I want out of dollars and into gold, or I want out of yen and into gold, or I want out of the euro and into gold. Once that happens, not the above ground supply of gold or the above ground supply of silver, the available supply, what's called the float in the stock market, how much is actually out there kind of floating around at market prices. Once that's gobbled up at market, then the next level is people that are holding on pretty tight that want to get a return on it, and they say, okay, give me this price. Well, if you're fearful that the price that you get for your gold or silver in dollars is not going to be worth much, how much selling is going to go on? Well, in a word, zero. And that's the problem, because if you don't know what that dollar is going to be worth in a day or 2 days or 3 days, it's just, look at what happened in Venezuela. Now, well, David, you're talking about hyperinflation, and yes, I am. And do I think that will happen in the U.S.? No, I don't. But I think that there'll be enough of a shift in psychology between what's valuable and what isn't, what can be trusted and what cannot be trusted, that there'll be such a shift that there'll be very, very tightly held strong hands in both precious metals with a lot of buying pressure and very little selling pressure. And they'll get to a certain level. And at some point, people will say, well, look, the Starbucks is still taking dollars, and, the grocery store is still taking dollars. And I just made, 10 times on my money. I think I'm going to take some profits. And that certainly will probably happen. So we haven't gotten there yet. I've been thinking about this for years. I haven't changed my opinion. It's happened over and over again in monetary history. But yet the powers that be seem to be able to keep pumping enough paper fiat into the system to keep everybody smiling, the banks solve it, and the game continuing. And I totally, completely, and 100% admit that. That doesn't mean that I'm wrong. What it means is I'm wrong in my timing. I thought by now we'd probably see more of a shift into the metals than we have seen. I also thought we would see more, blowouts in the financial system than we've seen probably. But you really don't know what's going on underneath the surface unless you study it, which I do. And, the retail markets have been shattered in the United States. A lot of people in the U.S. that used to have good jobs now are working 2 or 3. A lot of people that used to be able to save money cannot. They're living off of credit. So the overall tone continues to deteriorate, but you still get the happy, smiley faces on the mainstream financial press and in the mainstream press at large that, happy days are here, things are great, things are wonderful, they never look better. We're making things great again, blah, 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 blah. And in some areas have gotten better, but overall, the general physical economy has not gotten better. A few areas you can make exceptions to. Look at the oil price. The oil price is starting to firm again. And this, of course, is good for oil producers, good for oil stocks, but not necessarily good for those that run on energy, which is basically everything.
Now, a lot of people, or some people, I should say, in the gold and silver community, it seems like you were talking about how you would have expected this to happen a lot earlier, and we're still not seeing it happen if people losing confidence in the currency and the psychological shift, as you're talking about, moving towards precious metals. And it seems like, there's good reason to believe that'll happen, right? Because that's what has happened in the past. A lot of people in our community are kind of turning away from precious metals and are saying, maybe it's not actually true, and maybe this time it's different. Maybe it's cryptocurrencies that people will turn to. Maybe cryptocurrencies are the future. I'd assume your perspective is this time it's not different. So why has technology not made gold and silver obsolete?
Well, great question. So I'm going to digress a bit. First of all, to kind of clear the air, and I haven't done this in a long time, I, first of all, maintain from the very start that I could be wrong, all right? And if I am wrong, what is the correct approach? And if you read my 10 rules of silver investing that I put out to the public domain for a long time, I said that too much of a good thing is too much of a good thing, and I recommended a 10% hedge position in the precious metals. So if I'm wrong, you've got a hedge that if I'm right. Now, I believe I'm right, but I'm not addicted to being right. I'm not going to lose my sleep if I turn out to be wrong. And you can make the argument I'm right because 2008 happened. You can make the argument either way. I don't care. What I do want to make very clear is I've never said you should load up on gold and silver and that should be your only asset class. However, I have gotten through the years numerous times where people have read my work or others in our genre that I've read, I won't name them, but several people, the Bill Holters and, all these writers that are out there that are very good, deep thinkers. They prove it through history. And once they get convinced and they understand it, they say, well, what else would you invest in? And of course, there's lots of other things to invest in. So I've, through the years, gotten many calls and emails about, I read so-and-so, sometimes it's me, and I overloaded. I put too much in. So, the idea to be diversified actually, to me, carries a lot of weight. Now, I am overloaded in the metals and the mining stocks, but that's what I specialize in, and I'm comfortable there. But I had a gentleman from Australia, and he was a multi-millionaire businessman. He heard the silver story from another source, not me. And then when he heard me talk about, 20% is the maximum most people should have in the precious metals, he said, boy, he wished he had heard that before, because he thought, as others, that it's the only place to be. Things are going to fail. When things fail, it's the only man standing. Well, that's happened. But that doesn't mean that this time it's going to happen like that. It could happen where it's a crypto metals hybrid. It could be, it could be a lot of things, because I don't know the future. But my point is that I've always maintained, I think, a balanced approach, which means you need a hedge in the metals, period, forever. And it's been proven by portfolio analysis that if you have gold in your portfolio, you do better under all conditions. Uptrends, downtrends, bull markets, bear markets, sideways markets, etc. So I have statistics on my side as well as monetary history. So now that I've gotten the air cleared on that, is it different this time? And it's always different to a degree, because we live in a different environment technologically. Social mores are different. The moral structure of the society at large is different. You've got a more globalized economy and interfacing. I mean, I could talk to somebody in Europe with Skype for practically nothing. I mean, these things haven't existed, up until the present day. So, well, I think it could go both ways. One meaning that, as I said earlier, the run to gold will go into the history books, and I still believe that, because nothing is trusted outside of gold, or maybe a crypto that's tied to gold. That's the extreme case. I think we could see some of that. I mean, for example, Elijah, we could see where the bond market starts to crash, the stock market crashes along with it, interest rates start to spike, and a big name comes into the gold market in a big way. And they start to buy, let's say, the ETF, but they're also buying off of the Shanghai exchange and maybe a couple of the bigger wholesalers, and all of a sudden the gold market dries up, because, again, it's not the above ground supply, it's how much is available, what the float is like. Well, the float turns out to be very small. And so now it's all held in tight hands. I'm going through the same scenario, but that could happen. So after that spike and the things calm down, let's say, and, we get the talking heads out there, everything is fine. The only thing to fear is fear itself. The dollar is just going to rebound and be strong, blah, 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 blah. Things calm down, psychology is reversed somewhat, and the markets loosen up, and maybe they, mellow out to the point where gold backs off somewhat, but it's at a new base, it's at a new high level, and it's not going to go below that. It becomes a new floor for gold, and then it starts trading in a more, normal pattern. So, there's lots of different scenarios. I, again, want to maintain that my position is I'm a specialist in this area. I do natural resource companies across the board, not just the precious metals, although it's my main focus. And you can make money in that sector. And honestly, you can make more money in the paper part of it than in the physical part of it. I hate to say that, but it's true. I mean, you can get a lot of leverage in a good mining stock that you can't get when you own the physical. I still advocate that everyone should have a physical position, because it's the most readily available solid wealth anyone can have throughout history. And in any kind of a upset where there's an electrical failure, or there's a closure of a bank, a closure of a brokerage house, or you can't get to your computer, having physical solid wealth is certainly anonymous. It's does what the cryptos purport to do, and it's something that's been coveted by mankind, monetary history from day one. So still bullish, but be prudent about the amount. And that varies person to person. Now, you're going to ask me what's the correct amount, and what I'm going to tell you is going to blow your mind. But CPM did a study, and their study from 1968, okay, so not all of recorded history, 1968 to present day, the correct amount to balance your portfolio in gold, not in gold stocks, is around 20 to 25%. Can you imagine if the mainstream Wall Street types decided they needed, let's say, 5% in gold or 10% in gold? I mean, and this is very intriguing because David Hartwell, who's president of the World Gold Council and also in charge of Franco-Nevada, or one of the directors of Franco-Nevada, I should say, did an interview at the BMO conference a couple months ago, and I'd set up an interview for me to interview him, and we couldn't connect. But I digress to come back. And he is putting together a forum, and I think Alan Greenspan was invited to talk to some of these higher ups in the Wall Street community about gold and gold's balancing a portfolio longer term. And if that's occurred yet or not, I do not know. And if it may not take place, I think it will. But this is something that he's kind of spearheaded as the chairman of the World Gold Council to make, these entities aware of gold's position. So, the story isn't over yet. It's precious for a reason. It's very much underloved. It's very much not understood. And the actual amount of gold that's actually required to make your portfolio a balanced portfolio, not a precious metals only portfolio, perform best, is very, very much misunderstood.
All right. Well, David Morgan, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yeah, I'd just like to let everyone know that I have a podcast. It's sort of started to build up and it's kind of dropped off. I don't even know how to do it, but if you just type in, David Morgan podcast or the Morgan Report podcast in Google or something, I'm sure you can find it. Most of these interviews that we're allowed, like yours, where you do put on our podcast, because I know a lot of people, and I'm one, that likes to, drive around. I don't really want to listen to, a bunch of chatter or music. Usually I like to listen to, interviews of others that are talking about the markets or something that interests me. So that's available. And also, if you get on our free list, which is available at themorganreport.com with the first name and an email, we just validate that it's really you. We'll send you a bunch of information every weekend for free that basically summarizes any interviews I've done during the week, any articles that we think are of value for myself or others, and discounts sometimes. We've run specials with SD and a few other coin dealers along the path. So it's a free list. It's valuable to those that are interested in the resource sector.
All right. Once again, David Morgan from themorganreport.com. Thank you so much for joining us today.
Elijah, thank you.